Hey traders, today I'm sharing a simple trading strategy that's perfect for beginners. The system uses the same concept pros rely on, but it's so easy anyone can follow. My backtest showed a 73% win rate, so it's profitable despite being straightforward. No jargon, no complicated steps, just a clear way to make consistent trades. Let's get started. The main thing we focus on is an indicator often found in trading platforms called 3EMA indicator. The 3EMA indicator is described as typically showing three exponential moving average lines set to 10, 50, and 200 periods by default. These lines are usually meant to show different speeds of average price movement, but for this particular trading strategy, we don't use those standard 10, 50, and 200 period settings. We will set all three of the lines within that 3EMA indicator to exact same period length, 200 periods. But here's the crucial difference from a standard setup. Each of those three 200 period lines is going to calculate its average based on a different price point from each candle. Especially, the first one will track the standard closing price. The second 200 period line will track low price of each candle. And the third 200 EMA period line will track the high price. So it's the 3 EMA indicator, but instead of 10, 50, 200, it's showing the 200 period EMA of the close, the 200 period EMA of the low, and the 200 period EMA of the high. When you put this on your chart, these three lines don't just float separately. They form a clear visual band or zone. This area essentially shows you the typical range of the price moving average over the last 200 period, capturing the high to low volatility. And this band is your straightforward guide for seeing the trend. When price action is consistently staying and trading above this entire 200 period band, meaning it's above the line for the high, the low, and the close, that's your clear sign that the price is in an uptrend. You'll see candles closing above this whole area. This provides a much more reliable confirmation of upward movement than just using a single EMA, which price can often cross back and forth over without a clear trend. When price holds above this entire zone, it shows genuine strength. Conversely, when the price is consistently trading below this entire 200 period band, that tells you simply and directly that the price is in a downtrend. The band acts like a solid area of resistance overhead. Seeing price consistently held below this whole zone gives a much stronger indication of downtrend pressure than just interacting with one single line. For next step, we're going to add 3 EMA indicator again. But this time, it's our entry tool. Instead of 200 period setting, we're switching it up to shorter periods, 7, 20, and 50 periods. These three lines are going to show us where the price pulls back within the trend, giving us a chance to get in at a solid spot before the trend keeps rolling. Here's the logic behind it. Prices don't move in a straight line. They trend to stretch away from the moving averages and then snap back toward them. Think of it as the price taking a quick breather before continuing its direction. Our job is to catch that breather and use it to enter the trade. Let's break it down with an example. Say, we'll confirm a downtrend because the price is below our 200 EMA band. That's our starting point. Now, look at your chart and check out the 7, 20, and 50 EMA lines. Ideally, you'll see some space between them, like a little gap. That spacing is a good sign that the trend has momentum and it gives the price room to move. So what do? We wait. Watch for the price to pull back up toward those shorter EMAs. Maybe it touches 7, 20 or 50 line. But here's the crucial part. The price can't break above the 200 EMA band. If it does, we're no longer in a clear downtrend and the setup's off. As long as it stays below that band, we're still in business. Now focus on the 7 EMA line. It's our trigger. When you see a candle closes below the 7 EMA after the pullback, that's your signal to open a sell trade. It's telling us the price tried to bounce up, hit resistance at those EMAs, and is now ready to keep dropping. That's our entry. Clean and simple. Alright, so let's break down this chart. First thing you notice, you're clearly in an uptrend. And you can see the price is holding nicely above the big 200 EMA band. That's our baseline. Uptrend confirmed. Now look closely at the shorter term EMAs, the 7, 20 and 50. See how they're spread apart, kind of fanned out below the price. That separation is often a good sign of a trend strength. Because of that, we're anticipating a potential pullback. We'll be watching to see if the price dips back down to test these faster EMA levels. But here's the key rule. The one thing that has to hold true for this specific setup, the price absolutely must stay above the 200 EMA zone. If it breaks down below the 200 EMA band, this particular trade idea is invalid. Simple as that. So, assuming we hold above the 200 EMA band, where's our focus? It's on that really fast line, the 7 EMA. Think of this as your entry trigger. After the price pullback toward those shorter EMAs, we need to see it finds support and turns back up. The specific signal we're patiently waiting for, the moment we actually consider hitting the buy button, is when you see a full candle close back above the 7 EMA line. That candle closes above the 7 after a pullback in an uptrend is the confirmation we're looking for to potentially enter. Alright, theory is one thing, but let's walk through some real chart examples so we can see exactly how this plays out in practice. We'll start here on the gold 15-minute chart. You can see we're clearly in an uptrend. Price is above 200 EMA band. Right here, notice the price pull back toward those faster EMA lines. Then we get a bullish candle closing back above the 7 EMA. That's our triggers. So look for a buy entry there. And as you can see, it turned into a real nice profitable trade. Okay, moving forward a bit. Look, it happens again. Price pullbacks to EMAs, finds support, and then we get another candle closing back above the 7 EMA trigger line. Another potential buy entry, and that one also worked out for a profit. Fast forward a few hours on the same chart, same uptrend, and here we go again. Another valid buy trigger candle leading to another successful trade. Now it's important to be realistic. A bit later, we get another buy signal following the rules. Pullback candle closing above 7 EMA, but this one, it didn't work out. It turned into a losing trade. And that's perfectly normal. No strategy is 100% accurate. So expect some losses along the way. But watch what happens next. Just a few candles later, another pullback, another valid buy trigger. And this winning trade was enough to cover that previous small loss. So that's gold. Let's switch markets and time frames. How about Forex? Here's the Euro USD pair on the 30-minute time frame. Now look here. The trend is clearly down. Price is below 200 EMA band. The faster EMAs are angled down. So what we're looking for? Sell signals. Right here, price pulls up towards the EMAs. That's our pullback in a downtrend. Then we get a candle closing back below the 7 EMA, our sell trigger. Entered short, and that played out profitably. A few hours later, same scenario, another pullback, another sell trigger, another profitable short trade. But then, watch the chart. The trend starts to change. We start meeting the condition for an uptrend, so we adapt. Now we stop looking for sells and only look for buy signals based on our rules. And sure enough, here's the pullback. We wait, there's a buy trigger candle closing above the 7 EMA, enter long, and that trade made money. Right after exiting, maybe a few candles later, another pullback happens. giving another buy trigger, and that one also resulted in a profitable trade. You can see the next signal here was another winning buy. So to recap, we learned how to use the 200 EMA band to identify the trend and the shorter EMAs to find entry points. The system is simple yet effective. So let's dive into something I know you're going to find valuable. The backtesting results for this strategy on the Euro USD chart. I ran the system through 100 trades and here's what came up. It was profitable in 73% of those trades. That's pretty impressive win rate, right? For traders, this means you're looking at a strategy that's stacking the odds in your favor more often than not. The profit factor clocked in at 5.41, which breaks down to over $5 made for every dollar you put at risk. And the drawdown, a tiny 2.97%. So your account stays pretty steady. No wild roller coaster rides here. And what I love about this is how it shows you don't need some crazy complex setup to make money trading. Seriously. Keep it simple. This strategy boils down to a handful of clear rules. It's straightforward enough for beginners, but honestly, it's a solid approach for anyone trading in 2025. If this is clicking for you, hit that like button and subscribe. I've got more practical tips coming your way. I'd also love to hear from you in the comments. What's your go-to trading pair? What's your go-to trading strategy? Got any question about this strategy? Drop them below. Thanks for watching. You guys make this worth it.